with one another. Working group members and also our presenters are Zoom panelists in that vernacular, and you can use the chat to share comments and questions. Anyone else is an attendee, and we appreciate your comments and questions to come through the survey. We're also live on TVW, and we're being recorded. The recording of the session will also be put onto the work group website. Speaking of that working group website, Deanne is going to put a link for you into, or has already, I should say, put a link into the chat. If you haven't been there, there's lots of information available there. You may have seen an additional calendar invite come through for August 5th. We added one more meeting at this point to when all the presentations at that stage we think will be finished. You might tell us there's something else we need. We wanted to add another conversation just for discussion. So you probably saw a calendar invite. No additional registration is needed, and more to come as we closer to that date. Thank you for sharing your input. If you were able to for survey 3, you can see a summary of what we heard from you on the working group website. Survey 4 is open, and Deanne put a link into the chat. So I will also email it to you after this call, but if it is easier for you to type your comments or questions as we go through this meeting, it is available if you want to do that. And I think those are all the things for getting us started. So let me tell you who our presenters are today. Karen Collins, Vice President, Property and Environment, American Property Casualty Insurance Association. And then Firas Sala, you're going to have to help me if I have said your name improperly. Please correct me.
No, that is accurate. Thank you, Kellen.
Thank you. The Director of Product Management, Moody's RMS. Juliana, I need help with your last name.
Anastasados.
Thank you. Vice President of Wildfire Bursic. And Brian, is it Rare?
Rehor. Thank you very much.
Rehor. Thank you. Director of Regulatory Affairs, Zesty.ai. So we're going to have Karen share, open for some questions. Then we're going to have the other 3 folks, risk modelers, all speak, and then we'll open for some questions again after that. Of course, you have the chat. If you are a member of the working group, you can use that as we go along. And the survey is open for anybody who wants to make a comment or a question. So with that, Karen, let me take my slide down so that you can share yours. And over to you.
Great. Thank you. Hopefully you guys can see this now.
Yes, we sure can.
Okay. All right, fantastic. Yes, as mentioned, I am Karen Collins. I serve as Vice President of Property and Environmental here for the American Property Casualty Insurance Association. Click this. There we go. So we are a trade association representing home, auto, and business insurers that do have a presence in every community across the U.S. Our primary mission is protecting people and helping them recover from catastrophic losses. My goal today is to share some of the insights we can offer on catastrophe models, including an overview of them and how insurance companies leverage them before turning it over to some of these other companies that do actually provide the models for companies to use. So starting off, insurers, we do certainly look at extensive data to better understand risk and determine what level of exposure companies can responsibly assume without risking insolvency. Catastrophe models have existed for decades and really are a critical tool used by companies for numerous types of risk. With more data available and advancements in technology and analytics, this is allowing for significant advancements in modeling capabilities, which is increasingly important for our industry as we're facing more climate-intensified loss events. Now, catastrophe models are a financial tool designed to help quantify the financial impact of a range of potential future disasters by informing where future events are likely to occur, and how intense they are likely to be. They help provide a more comprehensive understanding of risks and potential losses associated with different catastrophes, enabling more accurate pricing and risk selection, really to ensure the financial stability of the company and certainly to protect policyholders following a major disaster. They are very critical in effectively managing overall portfolios. By analyzing the potential impact of different catastrophes on a company's entire book of business, including the impact of evolving climate trends, insurers can identify areas within their portfolios that may be overconcentrated to then mitigate excess risk. This might include adjusting their underwriting guidelines, further diversifying their portfolio, maybe increasing their risk transfer with things like reinsurance or catastrophe bonds, or encouraging more mitigation to reduce the likelihood or potential severity of loss for individual risks. Now, to support these actions, there's actually multiple types of catastrophe models. There are risk aggregation models that really help more with that broader portfolio management, while risk segmentation models focus more on the individual risk assessment and pricing. So aggregation models, these help insurers understand the cumulative risk across their entire portfolio, generating scenario simulations, which might involve modeling potential losses from very extreme but plausible event scenarios, really helps inform the total rate that is needed to cover all potential losses. These models consider a company's diversification across all lines of business, regions that they're writing in, and covered perils, amongst other factors. These models tend to look at loss probabilities, terms that you'll hear about, average annual loss and probable maximum loss. In short, these models help inform a company's overall capacity in the market, or really the size of their risk pool. Now, in contrast, risk segmentation models help assess and price the individual risks within that pool. These models look more closely at individual property factors that might lead to a loss or influence the severity of that loss, meaning how much damage it might sustain. The models also help inform the premium that should be charged for each company or each property individually. We have to keep in mind that insurance is simply pooling and distributing risk. So once you determine your pool, then you need to determine how to distribute that, kind of like the size of a pie and the individual slices within that. So these models really work together to help ensure a company's solvency through accurate underwriting, pricing, and risk transfer. Now, solvency risk is really what precipitated the development of the catastrophe modeling industry. If you go back to following Hurricane Andrew in '92 and the '94 Northridge earthquake. Andrew caused over $15 billion in insured losses, becoming the costliest natural disaster in U.S. history at the time, and it unfortunately led to nearly a dozen insurers becoming insolvent. And just a couple short years later, the Northridge earthquake caused over $12 billion in insured losses and led to at least 8 insolvencies. These events, with 20 insurance companies lost, exposed weaknesses in the industry's ability to handle mega disasters, resulting in major changes in how catastrophe risk was managed, including the development of CAT models. Now, fast forward, we saw 7 landfalling hurricanes during the 2004 and 2005 Atlantic hurricane seasons, further impacting modeling assumptions. Record losses from those events forced a closer examination of aggregate losses from multiple large events. Hurricane Katrina in 2005 also caused more losses from secondary flooding than the traditional wind-generated events. So CAT models have since been developed for a variety of catastrophic perils. Primary perils, which typically generate the highest severity of loss, include hurricanes and earthquakes. Though CAT models now exist for secondary perils, those which are more frequency-driven events, such as floods, severe storms, winter storms, and of course, wildfires. CAT models are based on science spanning a wide variety of fields that includes atmospheric science, environmental science, actuarial science, and engineering. And really, in an era of climate change, drought, and an increasing number of communities in high-risk areas like our wildland-urban interface, insurers simply cannot rely on historical loss experience alone. It would be like driving while looking in your rearview mirror. So CAT models help insurers better account for the conditions that exist today. Now, wildfire CAT models specifically look at numerous factors, such as the interactions between weather, local vegetation and topography, and they catalog historical fire footprints. I've heard in a lot of presentations that fire behavior in the natural environment is pretty well understood, how it moves over the landscape. But when a fire transitions away from vegetation to vegetation spread to instead vegetation to structure, and eventually structure to structure spread, this is where models are not quite as robust and where the greatest focus of research is currently. Those pathways that enable fire to spread within the built environment, leading to conflagration losses. Many wildfire CAT models today do consider community and parcel specific factors, such as defensible space and construction materials. They might leverage aerial imagery, such as satellites, to help assess roof condition or vegetation that's adjacent to a home, or other data records to verify a building's features that are not visible from above, such as maybe siding material, type of windows, enclosures of eaves and vents. Now, while CAT models do differ, here you see examples of various factors that wildfire models might consider. Now, these data inputs collectively contribute to a risk score. Homes on the same street may have different risk scores based on how they are constructed and their proximity to where fire is more likely to originate and spread, such as maybe a hillside. Risk scores can also vary for the same property between different catastrophe models based on the model's data inputs, where they have sourced that data, and how the model itself is designed. Some insurers develop models in-house, while others might rely on models developed by third-party vendors. In either case, a wildfire risk score is one of many factors that insurers consider when underwriting and pricing. And the extent that that risk score is relied upon versus other rating factors is also going to vary. So for example, if you have some companies that maybe are in a stronger financial position to assume more risk in their portfolio, they may choose to accept properties with higher risk scores. Now, a big challenge with wildfire modeling is that we really are in a new era of wildfire risk, and really since 2017, the scale of conflagration losses that we are seeing. The growth in asset values and hazardous fuels in our WUI areas, coupled with intensifying climate conditions that are simply more conducive to fire ignitions and spread, are leading to much larger and costlier wildfires. When you look at wildfire losses in the last decade ending in 2024, these losses were nearly 10 times higher than earlier decades, with the fires this year in Los Angeles eclipsing those numbers well before fire season. These are volatile trends. And wildfire is unique in that losses are not limited to events from Mother Nature, adding to the volatility for this particular peril. We're seeing, unfortunately, a growing number of utility-involved ignitions across Western states during high wind events, which is contributing to some of these costliest and deadliest losses in history. Here you can see the top 20 costliest insured loss events from wildfire in the US, and those that are shaded in orange indicate a utility-involved ignition. And we're seeing these large conflagration events in a growing number of Western states. This similarly shows the top 20 costliest insured losses from wildfire in the US, but filtered to just those events that have happened since 2017. Now, following the 2018 Camp Fire in California, we unfortunately saw one company become insolvent, Merced P&C. This was a 100-year-old small regional carrier that unfortunately became overexposed due to a high concentration of homes in a more inland rural area of the state. Separately, the largest homeowners insurance company in California is currently in financial distress after the LA fires. This company recognized they were overexposed, so just months before the fires, media reports indicated the company was taking steps to de-risk by non-renewing a large number of policies in some of the highest risk areas. The company was, unfortunately, the timing is unable to complete this prior to the fires and suffered significant financial losses that potentially could have threatened maybe their solvency, according to media reports. Now, fortunately, the company was able to arrange a capital infusion from its parent company and also negotiated a sizable emergency rate increase with the Department of Insurance to help stabilize that company. And they're taking steps to further stabilize. But the fires also resulted in losses that exceeded the claims paying capacity of the state's residual market known as the California Fair Plan. And that led to a $1 billion assessment issue to all private insurers in the state. So we see the solvency risk for small and large carriers in rural areas, in urban areas. These impacts underscore the importance of catastrophe models to ensure adequate capital to help cover very high severity events. Now, insurance is uniquely different than most other products consumers buy because it's priced on the probability of an event that may or may not occur in that policy period. But unlike FEMA or our National Flood Insurance Program, which maybe they may be able to secure a federal bailout in the case of a really severe loss, if private insurers underestimate their potential losses, they risk insolvency. Media coverage that I've seen from the LA fire suggests that the event was accounted for in CAT models. For example, Renaissance RE described it as a tail event, meaning CAT models recognize that this event in that area and with that magnitude of loss was possible, though recognizing it to be a potentially extreme scenario. So after the event, it was suggested that CAT models may need to steepen their tails, meaning increasing the probability of that scale of loss reoccurring. RenRe also noted that the impact on severity from the value of property, demand surge impacts, additional living expenses while out of the home, and the impacts of smoke all contributed. These are all tied to that lower corner of the wheel. Conflagration fires are uniquely more challenging for communities. Data shows from California that over 90% of homes that ignite in a wildfire are a total loss. This results in very high loss severity due to the loss of the structure, all of the personal property inside, and the intensity of the fire may damage foundations and retaining walls. That requires a lengthier debris removal and environmental cleanup process prior to reconstruction, which adds to the additional living expenses while out of the home. Now, with other disasters like maybe hail or tornado or hurricanes, maybe only part of the home was damaged, or a temporary repair might allow you to move back in while the rest of the home is repaired. So these challenges that we face in the wildfire situation has led to various legislation in Western states to provide consumers with more coverage benefits and lengthier timeframes in that recovery process. Don't mistake me, these are well-intentioned, though this broadening of coverage does create higher costs and more volatility for insurers to then model and price wildfire risk. And we are seeing more fall-on losses, like I mentioned, losses from smoke damage. We've also seen potential mudslides after wildfires. All of this to say, insurers in Western states are facing similar economic pressures from things like inflation that are leading to higher costs, as we're seeing across the US. But companies are also working to adjust their capital to account for these higher potential losses that we're seeing due to wildfire. In some cases, insurers may need to de-risk their own portfolios, often through stricter underwriting or temporary pullback from high-risk areas until they can strengthen their financial position. Now, historically, as rates catch up, we see availability issues ease, though it's affordability that becomes that longer-term issue that we're working with all these Western states to address. Now, insurers are also using CAT models to help provide mitigation discounts to help in reducing consumer costs. Though what's really critical to understand is that the science shows wildfire mitigation requires a set of actions taken together to meaningfully reduce risk from wildfire. And also unique to the wildfire peril is that among these actions, defensible space must be an ongoing effort, and it really needs to be done at community scale. So this is, again, very different from other perils and poses some very unique challenges for insurers and others in the wildfire space and how they must verify wildfire mitigation to in turn model an appropriate risk-based discount to then provide to consumers. Finally, I would like to highlight the difference between publicly available hazard maps versus the risk models used by insurers, as there's been significant confusion that we have seen in media in different states between the role of these tools. At a high level, a hazard is anything that can cause harm, whereas risk considers the chance or likelihood a hazard will cause harm, in addition to the extent of damage that would result. That's the key for insurer, the extent of damage. So for hazard maps, these are developed for use by policymakers as they're critical to helping inform land use policies, meaning where we build, what building codes we want to adopt and enforce, so how we build, hazard disclosures, and other allocation of resources, like maybe a grant program. So there's work underway in a number of Western states to either create or update wildfire hazard maps to help policymakers understand and better manage state and local government policies and resources in wildfire-prone regions. What's important is that these publicly available wildfire hazard maps do not influence insurance rates and coverage determinations. Instead, insurers leverage these risk models, CAP models, which are, as I mentioned, often internal proprietary maps and methodologies that are simply more granular in nature to help assess individual parcel risk. These computerized models consider many additional factors that importantly change potentially more frequently, like what mitigation has been done or evolving fuel loads, that then can better inform the extent of potential loss that could occur in a single policy term for an individual insurer and that loss that might result. So I just want to stress that, again, publicly available hazard maps do not influence insurance rates and coverage determinations. And we were actually able to confirm this in 2022. The Oregon Division of Financial Regulation, their DOI, did a survey, a mandatory survey of members, and they all were confirming the same. So that we just want to make very, very clear, because we do see a lot of confusion in public discussion on that. So in closing, companies do need tools necessary to manage what has become very rapidly evolving wildfire risk and costs, while we continue to work with all stakeholders to help reduce that risk. But CAP models particularly are a critical tool to help ensure more available and affordable coverage, and certainly in reducing solvency risks. So with that, I will say thank you. And if others are interested in more information, we always should provide a little bit of a deeper reading materials if you are interested.
Thank you so much, Karen. We'll take a few questions, comments. Anybody want to share, please use the raise hand function. Please, David.
Thanks, Kelly. Karen, hi, this is David Fort with the OIC. So we're kind of tracking that some states have required or considering requiring insurers to provide their wildfire risk score information to their policy owners. And as this work group kind of considers that as a part of their recommendations, how is the implementation going for insurers needing to comply with the other states' requirements?
So when we think about a wildfire risk score and all the different types of factors that can go into leading to that risk score, they vary by company, and so there's not a standard that's going to be exactly uniform. And so when you provide a risk score, what we're seeing with other states is if you are overly prescriptive and how that needs to be communicated, it becomes a very, very challenging technical exercise for companies that involves a lot of cost. And so while we appreciate the desire to communicate risk, we would prefer to see more of a flexible approach on what's included in any sort of disclosure notice, just because of the programming aspects of that. And so you're seeing in some cases, some states that are just requiring more of a description of kind of the category of risk without going into the exact specifics by property. Because once you start programming, my property has X, Y, and Z, the extraction of that from the computer systems are very challenging. So if you have more of a general description that we call more static versus dynamic programming. Static is fixed language that can be applied for many people versus dynamic, which is pulling individual information into then a form and the formatting of that. We like to see more flexibility with that, where we can then provide stuff through either the website that people can research and then contact their company, or a more generalized description on a form. So there's trying to just find a balance, and how detailed do you want, including, what are factors that are even within the control. Like, you can't control the slope that you're on. You can't control how Mother Nature and wind speeds move. You can't control maybe the mitigation that you can do, and you can provide maybe a summary or talk to your insurance company what that action might be to influence some of that. And so there's more generalized ways to approach that. And so I would just caution just to avoid anything that's overly granular just from a programming standpoint. We've seen some companies that obviously have done that, but the risk to the marketplace is that if it becomes so overly technical, you often see more adverse impact on smaller companies that just don't have the scale to address some of that. And so this is where we've seen sometimes in California, which had some of the most prescriptive approaches to some of the requirements. We actually did see media reports of some companies that said the regulatory compliance was a little bit more too difficult for them to achieve, and with the cost of that. And so we've seen companies exit their market for that reason, amongst whatever other considerations that they had.
Thank you. Senator Short, over to you.
Thank you so much. Had a couple of questions in the chat that I wanted to follow up. So first one is the CAP models, you say it is an important tool to identify risk. Is it the only tool, or can you explain other tools that insurance companies use? And then secondarily, there's a lot of things predicated on distance to a fire district, but I'm wondering if that also includes if insurers are also looking at the specific capacity of a fire district to fight fire and protect their communities.
So let me start with the second question. And I know that we do have a speaker that's going to be speaking on behalf of Verisk, which owns a company called ISO. So they may provide more insight here. But there is a public protection class, PPC score, that I think insurance companies have used for a lot of years, and not necessarily every company, but many, I believe, do. It's a pretty standard one. It's been in existence for a while. And it helps to identify what is the emergency response to fire. And this is generally in response to maybe a house fire. So if you have a paid fire department versus a volunteer fire department, do you have access to water? Do you have the ability to get into an area with emergency vehicles? All of that in the response time. There is existing data and models and scores that do consider all of that. Historically, it has looked more at responding to an individual house fire. The challenge with conflagration is that we are seeing tens, if not hundreds or thousands of homes going up at once, and often under very severe wind conditions. That conflagration fire response is very different from when a fire department needs to come out and respond to just one or two houses on fire. So there is efforts underway within the industry to better understand what is the potential fire response to conflagration. And so there's various research entities. I've spoken with one fire chief who's now retired, Chief Dave Winokur in California, who's working within that space to develop what would be a similar way of modeling and potentially scoring the capacity of individual local governments and what are their resources. It's very different equipment, trucks and things that go out to respond to a wildfire out in the natural vegetation versus those that are within, obviously, an urban, denser populated area. So we're working towards that. We're working very closely with the fire community to see the advancements of that. Just want to make that nuanced difference, though. For the first question, are there other data or tools? Insurers look to a lot of different tools. There are standalone tools that they might look at for trying to understand risk assessment. I'm sure some of the companies here will maybe speak to some of what data sources they look to. Companies can certainly look to getting data from sources directly that are separate from maybe what's in a catastrophe model. There's obviously the in-person underwriting that is also very critical in many property types. Catastrophe models are available for residential and commercial property risks, but even commercial risks are so uniquely different. They're not a very cookie cutter structure. And so you see very different approaches and more customized underwriting, even on the commercial side for those reasons. So yeah, there's a number of different sources, and I wouldn't be able to tell you all of them off the top of my head, but catastrophe models are certainly one tool, and they are getting more robust in what they're incorporating. You'll hear a lot more from the three vendors today that help develop and provide those.
Thank you. Senator Short, did we hit on the questions that you put in the chat there? I think so.
We did. We did. Thank you.
Perfect.
Great.
Thank you. Commissioner Kuderer, over to you.
Thank you, Kelly, and thank you, Karen. Really appreciated your presentation, and very much appreciated you pointing out that the industry does not use the public risk maps and the difference between the two. I think that is something that the public doesn't know, generally speaking. Mm-hmm. I have a question about how the insurance industry confirms the accuracy of the models in Washington State. Now, I know that you contract with companies to do that CAT modeling for you, but how do you make sure that what they're doing and the data that they're looking at is accurate for Washington State?
There's, I believe, extensive data validation with the inputs that companies have. I know that they do work closely with their modeling vendors, and so I'll let the modeler speak to what a lot of that is. I know that there's been a lot of discussion in the aftermath of each of these events where the modeling companies will go back and rerun their models to simulate that and compare them and the accuracy of that. And so I don't want to overspeak for what that exercise is, because they will probably be able to more eloquently describe what that validation is. But in all of the conversations that I've been a part of in different discussions in different states is that surprisingly, like, the models have actually performed very, very well, like really high probabilities, percentages of what they simulated versus how the wildfires actually unfolded. And so, well, I contrast the natural environment versus the built, like, you're actually seeing really, really strong performance on these.
Okay, and I want to be clear then, because what I'm hearing you saying is that you rely on their validation. You don't do any independent validation within the company. Is that correct?
I don't want to suggest that is. I just don't know where that difference exists. I know that in even my observations and discussions with California, which has gone through a really lengthy exercise with catastrophe model, in their regulatory review process, companies are providing information at the department's request of how they then leverage the models, if they're making adjustments to anything or assumptions based on. And so while a model is provided to the company, they may also do various ways of how they're leveraging the model. And so how they leverage that is being discussed with the department. There's like a whole series of questions that they have. And so we could probably follow up and give you maybe more on that. But
yeah, that would be great if you would do that. I appreciate it. And I also just want to thank Senator Short. I actually second her question. I think it's really important, that we consider the fire department's capabilities as well. So thank you.
Thank you. Robin.
Hi, thanks. Thanks for your presentation, Karen. My question is around, for the CAT models, how is risk assessed for the various vegetation types and fuel loads? So, specifically, like, is there a ranking? Like, are trees considered higher risk compared to grass, for example? Because I thought I heard you mention fuel density, and we often talk about dense forest fuels as a hazard, therefore creating risk. But grasses often carry wildfires into communities. So I was just wondering if you could talk about how those different vegetation types are ranked.
Yes, I would imagine the other vendors will probably speak to this, but at a high level, there is absolutely distinct differences between type of vegetation density. When you're out in the more natural wildlands, you see more heavy forestry and timber. And if you have a lot of ladder fuels that allow fire to get up from the ground up into the tree canopies, then you have crown fires that spread and they're more difficult. You can't suppress them. You have to essentially wait for the fuel loads and try to lay those down. Those haven't resulted in the largest, typically, insured loss events. What you describe with the grasslands is what is leading to more fast fires. Fires that we've seen in Colorado with the Marshall Fire and with Maui, the Lahaina Fire, where you have flash drought conditions and the fires have burned through the grass to get to the community, often under high winds, and those fast fires that allow them to reach into the community, and then the fuels that are within the community, the connective fuels, whether it is wood fences like we saw in the Colorado Marshall Fire, or if you've seen vegetation that's right up against the properties and they spread between, structure to structure spread, and that then becomes the fuel source. And certainly once the homes ignite, they then also become the fuel that keeps propagating the fire forward. So there is definitely models looking at different types of fuel vegetation. Again, as I mentioned, these fast fires that are more in the suburban areas are where we as an industry are seeing the largest structure loss, property loss. So that is probably an area that we're focused on intensely, and this is why you're seeing a lot of effort to research, what is the fire suppression capabilities with a conflagration fire to prevent that from getting into the community like that. But also, what are the connective fuels around home? So the Insurance Institute for Business and Home Safety, known as IBHS, they have done a lot of research with the entire research community, and they have their wildfire prepared home framework. It is a science-based standard that tells you this is what the science shows it needs to be from a defensible space. And so that 5 feet from your home is what, if you have combustible items in that, whether it's vegetation, plants against your home, even if you think they're green, we've seen tests where you plant something brand new from the nursery same day, it looks green, but under the conditions with fire and the intensity of the heat that we're seeing between structures, it will ignite. And so you have to have that 5 foot is the critical. Non-combustible siding windows help, obviously not allowing embers to get into your eaves. We've seen $1 million homes down in Laguna Niguel, which is like Orange County, California, just above San Diego. And these were beautifully well-maintained properties, but they allowed embers to come up through the attic space, ignite, and burn the home from the top down. And so you're seeing a wide variety of ways that fire is penetrating and igniting within the community. Vegetation is usually one of those starting points when it starts out in the wildlands. Fast fires across the grasses that then come in, and then you've got all these different ways that it, like a wick, just starts to spread through the community, and then the embers start to flow through, and then they ignite homes from either roofs that are not, non-combustible, or they come in through the eaves and vents. So this is why you have to have that whole set of actions to really create that that defensible just kind of barrier for your home to prevent the ignition. Because once it does ignite, more often than not, we are seeing all of these homes being completely lost.
Thank you. Okay, let's move to our next presentations. We'll hear these next 3, and then we'll open for more questions. Of course, you can use the chat and or the survey if you have thoughts as we're going along. So, Juliana, let me hand over to you.
All right, I'm going to share my screen. So let me confirm that you're seeing my screen.
It's still loading. Oh, I see it. Yes.
Okay, great. And you can hear me okay? So really appreciate Karen's introduction, especially focusing on how insurers use our models. And so I'll get a chance to focus on the models themselves. My name is Juliana Anastasados. I'm the Vice President of Wildfire at Verisk. As background, I come from a long career in the insurance industry as a regulatory and claims attorney, and also a government relations professional for a large national insurance carrier. In this current role that I have at Verisk, I have the luxury and honor of focusing on Verisk's overall wildfire risk assessment and management business strategy, and with the goal of ensuring that we are providing our clients with the most predictive, scientifically robust, and technologically advanced tools to help them do their business. I also serve as a public-facing spokesperson to educate key stakeholders about our tools, key stakeholders like yourselves. And so I'm very honored to be here to serve as a resource for this group as it considers the many important issues related to wildfire risk for the broader Washington landscape, and specifically as it relates to insurance risk assessment and management for what we call in the insurance industry the wildfire peril. My goal here today is to give you a deeper understanding of one specific tool that Verisk has developed to assist our clients with wildfire risk assessment, and that's our wildfire risk scoring tool known as Fireline. You may have heard these tools referred to as solutions tools, most commonly as models. As you can see here, there are myriad references to this term model. These are some of them. This is actually a non-exhaustive list of the models that insurers might use for various purposes in managing their business. And I'm not going to talk about all of these. They're all built differently. They function differently. They use different kinds of inputs, provide different outputs. and they have different purposes. And so I just want to point out that attempting to group all of these different types of insurance models together for regulatory purposes, it can be quite a challenge. And it's really a crucial threshold question when you're talking about insurance models to understand what type of model you're talking about. Now, Verisk offers both a risk scoring model and a catastrophe model for wildfire risk assessment. These are the two models that we provide. Our Fireline model is the one I'm focusing on today, which is our address level score. But we also have our wildfire catastrophe model. It's known informally as a CAP model, more formally as the Verisk wildfire model for the United States. There are a number of modeling companies that offer either a risk scoring model or a catastrophe model for the wildfire peril. Verisk is one of only a few companies that offer both of these tools. And as I said, I'm focusing on Fireline today, but I do want to briefly touch upon a misnomer and something I feel compelled to clarify on this one point about the CAP model. The term CAP model, especially from a modeler's perspective, is a term of art. And we mean something very specific when we're referring to a CAP model. And what I mean to say is that not all models that assess wildfire or another catastrophic peril are necessarily considered a catastrophe model. A CAP model is a sophisticated computational model. It simulates millions of actual and possible wildfire events. It creates tens or hundreds of thousands of years of what we call stochastic years of wildfire behavior. And the ultimate output of the model is a financial metric that enables an insurer to understand their potential financial exposure so that they can plan for the next year. Karen touched upon some of this. The output might be expressed as an average annual loss, or an AAL, but the real hallmark of a true catastrophe model for insurance purposes is that it creates what's known as an exceedance probability curve, or an EP curve. This is the metric that gives carriers insights into the probability that the carrier will experience a certain level of financial insured loss given the makeup of their portfolio. It helps them plan financially to ensure that they have enough capital reserves or reinsurance, and that they'll be able to remain solvent should one of those extreme events happen in the following year. If the model doesn't put out an EP curve, then for us, that's not what we call a CAP model. So this is just something that I want to level set on. As a modeling company, we distinguish between a true CAP model and a risk scoring model, which is the one I'm going to talk about today. They're both extremely useful. They're valuable. Their outputs and purposes are a little bit different, but they're very complementary. So I'm going to focus on this Fireline piece. If there's a need for anybody to understand the CAP model more, we're certainly always open and willing to provide a deeper dive into that. We're happy to do that and set that up as a separate talk. The first thing I want to do is just level set on who Verisk is. So we're a leading strategic data analytics and technology partner to the global insurance industry. All of our tools empower our clients to strengthen their operating efficiency, improve insurance underwriting and claims outcomes. We have tools that combat fraud. We help our clients make informed decisions about global risks. This includes climate change, extreme events like wildfire, hurricane, political topics, and ESG issues. Our clients include insurers, reinsurers, as well as agents, brokers, self-insured businesses, risk managers, financial services firms, regulators, as well as various governmental agencies. And we are also proud to support local communities and the fire service with our ISO public protection classification program. And Karen mentioned that a few minutes ago. Now, we understand that you might be interested in knowing why a company like Verisk might be viewed as an authority in assessing and measuring the wildfire risk for the insurance industry at large. And so I'll start by pointing out the basis for the credibility behind our tools. Verisk's Extreme Event Solutions division, which is where our models are developed, houses over 150 scientists, with 90 or plus of them holding PhDs in multiple disciplines. All of these scientists contribute to the creation of our models on some level, and our wildfire team has specific scientific expertise in the disciplines that are relevant to wildfire, including climatology, remote sensing, meteorology, vegetation and crop science, and engineering, to name a few. These are scientists by trade and training. They're continuously studying and collaborating both formally and informally with academic institutions, governmental agencies, organizations like the IBHS. We have 2 researchers that serve on IBHS Research Council, and we also participate in the Climate Council. And so we draw upon this vast experience in data management and our expertise in predictive modeling. And it's worth noting that beyond wildfire, we have a long history of evaluating risk from many perils, including earthquake, hurricane, and flood, for example. For the wildfire specifically, these are some of the issues that are at the forefront of our clients' minds. Karen talked about this a lot, so I won't get too much into detail about this. But these are then also at the forefront of our researchers' minds as we develop our models to make sure that our clients are able to answer these questions and concerns. All right, so let's get to Fireline. Fireline is our property level risk assessment tool. It's part of our location suite of products. It helps characterize the wildfire hazard at the address level. It's used by carriers for risk selection. It might also be used to develop relativities that would show, these are pricing relativities where they might charge a different rate for a more at-risk property. You might find it interesting that we developed Fireline originally in the early 1990s following the Oakland Hills fire. And it was in response to insurance carriers' requests for a tool to help them understand the wildfire risk better. And before that, the only tools they had available to them were things like zoning and hazard mapping, which, as Karen pointed out, isn't really appropriate for insurance risk assessment. They weren't responsive to growth. They didn't have the necessary granularity. And frankly, they didn't have the wildfire science supporting them. Now, while Fireline was the first and for many years the only such tool in the market, we've continued to update and enhance our tool, and I'll discuss a little bit more detail. But suffice it to say that Fireline's predictive value has stood the test of time. It continues to provide valuable and actionable insights for our insurance carriers. Now, this Fireline always provides a score and insights that are specific to an address or lat-long location. But you might have seen this map before. We have created this map using all of the Fireline scores that are generated in the 14 states where the tool is currently available for. This appears in our annual wildfire risk reports. And you may have seen the map. The red definitely signifies high and extreme wildfire risk. But I want to make it clear that when carriers use our tool, they don't use a map. They get an address-specific score and reports with very granular insights about the specific conditions on the ground at each location. And so we are not using data from California to assess the risk in Washington. For example, that's a question we get a lot. We are looking at the conditions on the ground in the state where our tool is assessing the risk. Now, I've already mentioned the deep bench of scientific experts that we have at Verisk generally, but I just want to point out the breadth of expertise that undergirds Fireline specifically from its original development in the 1990s and continuing today with our ongoing maintenance and enhancements that we make to the tools. In addition to the PhD scientists who developed the tools, we consulted with insurance industry experts, computer scientists, and community fire protection professionals, including state and local wildland fire experts, state fire marshals, departments of forestry. As you can see on the right, the Fireline provides a baseline wildfire hazard score between 0 and 30, with 30 indicating the highest risk. Now, 0 does not mean no risk. It just simply is the lowest possible score on the scale. The scores assist carriers in understanding the relative risk, as I said, that a particular structure will be damaged by a wildfire should it reach the property. They might use the score, as I said, to help them determine whether to accept a particular risk, and in some states, they might use it to create rating relativities. The scoring system incorporates these well-studied and well-known factors that are identified by the NFPA and other wildfire practitioner scientists and scholars as being the most critical for evaluating the wildfire hazard. This includes the vegetative fuels, topography or slope, and finally the road access. These are the 3 critical wildfire factors at the property or in its vicinity, which decades of measuring these features has shown provide the most accurate and predictive measure of the overall wildfire hazard. Now, for the purpose of the base hazard score, fuels are by far the most important factor to the score creation. And this is because those fuels are actually the most important factor for the actual wildfire risk. Someone asked this question earlier about whether we distinguish the different fuels. And in fact, our proprietary algorithm analyzes very high quality multispectral satellite imagery. We consider what the fuels consist of, their moisture content, how combustible they are, how they're distributed. We look at this both immediately surrounding the property as well as further out to a quarter of a mile. It's a very sophisticated analysis that WILD developed many years ago. and ground truth by our scientists over the years. It's been enhanced and updated to account for advances in technology, as well as for the changing climate, which affects both, as we know, drought conditions and wind patterns. It's also very important to analyze how the vegetation changes over time. And so we update our fuels analysis at least biannually, or when we become aware of a major change to the composition of the fuels that might be as a result of an actual wildfire, a prescribed burn, or development into the wildland-urban interface. The second factor that we consider is the terrain or the topography, and this is referred to in Fireline Solution as slope. This is because we know that the slope at a property can have a significant impact on the risk. It accounts for how fast the fire spreads, what the flame length might be, and the slope can also be influenced by winds, especially in certain areas of the state. This is a factor that is easily verified and really doesn't change once it's established. The final factor in the base Fireline score is the road access, and this is a proxy for suppression. So as we know, a home that's on a dead-end street is more inaccessible to fire protection professionals. It's at greater risk than a home that has easy access by firefighters. The road access factor is only available or applicable to dead-end streets, while all other streets will get a 0 for that factor. But it's not just being a dead-end street. We also look at the fuels along the road, the length and the width of the road, for example, all of which can also impact its accessibility. Now, those are the basic features of the base wildfire hazard score. But in our enhanced, and those are the same as the ones you'll see on the left there, but in our enhanced Fireline product, we have a separate analysis for what we call special hazard zones, or SHZ. These are areas in the built environment that are adjacent to the wildlands that are especially vulnerable to these urban conflagrations that we've seen lately, where once the fire transitions from the wildlands into the built environment, the structures themselves become the fuel for the fire. And Karen talked about this a little bit. We know that the fire spread changes when the fuel is no longer solely vegetative fuels. And this analysis is of great interest to our insurance company clients because this is where they experience those really significant insured losses versus when the fire is a true wildfire in the sparsely populated wildlands where the structures might be scattered. These are the types of fires that the common nomenclature of wildfire actually is not exactly descriptive. And instead, one of our wildfire scientists describes these fires more as fires that have gone wild. Now, while the general public has only more recently began to understand the difference between true wildland fires and these urban conflagrations that give rise to significant insured losses, Verisk has been studying the impact on the insurance industry for many years. In fact, we developed the SHZ following the Tubbs fire in 2017. It burned through Coffey Park, and we added it to our product offering in 2018. What the SHZ measures then is the risk that we've seen recently, like in Southern California or also in the Marshall Fire. So in order to really appreciate the full power of Fireline, the SHZ analysis is critical to a true understanding of this type of risk. One of the challenges, and the commissioner brought this up about how do we validate, one of the challenges in understanding the predictive value of such features of a model is really the dearth of the data. And as tragic as events like Marshall and Palisades and Newton are, the value that they provide to modelers is that they give us the data to evaluate how predictive the models are. In fact, within a couple of weeks of the Southern California fires, I accompanied a team of our researchers to conduct a post-damage survey of the areas. We were focusing both on the structural features of the surviving homes, as well as looking at how the neighborhood layouts, the composition, and the proximity to the wildlands influenced and impacted both the vulnerability of the structures as well as the spread into neighborhoods. And these data inform enhancements in accuracy for both the vulnerability component of our models, as well as our understanding of urban conflagration spread. I can tell you that in addition to conducting that survey, we've also been thoroughly analyzing how well our base Fireline score and the SHZ, when used together, predicted the losses in Los Angeles. And what I can tell you generally is that 100% of the structures destroyed in Southern California were flagged as being in some level of special hazard zone, demonstrating that this is a powerful predictor of loss that can help insurers make informed underwriting decisions and also to assist in creating accurate pricing that aligns with the actual risk. In addition to adding the SHZ in 2018, in 2022, we enhanced the basic hazard score to also reflect any risk reduction that might come about from mitigation actions. that a property owner might take at their parcel, including hardening the structure itself or in reducing the surrounding vegetative fuels or other combustible materials located near the structure. And so this current version of the tool allows users to input the mitigation features that are called out by the IBHS Wildfire Prepared Home, for example, or other parcel level mitigations like defensible space. It also allows the carrier to recognize membership in a Firewise community, for example, the NFPA Firewise recognition. The presence of these mitigations will reduce the score, which potentially makes the structure a more acceptable risk to an insurance carrier who's assessing the risk and deciding whether or not to insure a given property. Some of the information is gathered using very high quality aerial imagery. This is an example of the aerial imagery that we have. It has a 7.5 centimeter resolution, and our machine learning algorithm interprets the imagery and can pre-fill some of the mitigation features that will improve a homeowner's fire line score. Importantly, all of these data are updated on a regular cadence that uses comprehensive data sources. We use Landsat multispectral satellite imagery, aerial imagery, weather and climate data, road networks, NFPA Firewise community information, for example. And we have an expanded partnership with NFPA. We get that data directly from them, so we can actually pre-fill the field of whether or not that home is located in a Firewise community. Our current and most up-to-date version of Fireline, which includes both the SHC and the mitigation actions taken at the property or in the community level, has been in the market for over 2 years. It's been formally reviewed by the Departments of Insurance in California, Nevada, Colorado, and Tennessee. And significantly, it's important to note that we have long had in place a review process whereby should a homeowner believe their score is inaccurate or out of date, they can make a request to have the score reviewed and updated. The final slide I want to share actually just depicts how the carriers might use these tools or how they use the risk model and the catastrophe model. These are some of the things Karen already mentioned, so I won't spend too much time on this, but it is said that a risk cannot be managed if it can't first be accurately measured or assessed. And so that is what Fireline and our catastrophe model do for the insurers, is create an accurate measurement and assessment. These are tools that are used for different purposes across the entire workflow for the insurance carrier. It allows the insurers to have a more comfortable feeling about their risk management, and it ultimately leads to a more robust and sustainable insurance market. So with that, if there are any questions.
Thank you, Anna. Thank you, Juliana. Actually, Tony, if you don't mind, I'm going to finish the other two folks present on this topic, and then we'll come to all the questions. And we also have a few others in the chat as well. So Tony, I'm going to come back to you if that's okay. Sarah, let me hand over to you.
Yep. Thank you, Kelly. I'll show my.
Thank you.
Okay. Perfect. Can you see my screen in full? Okay. Thank you very much. Okay. So good morning, good afternoon, everyone, and really appreciate giving us the opportunity to be part of this very important meeting and working group. My name is Firas Ali, and I oversee the North America Wildfire Modeling Solution within Moody's, and I also oversee the flood modeling solutions. I have been with Moody's for about 5 years now. Prior to that, I spent more than 15 years of my career in academia, teaching graduate classes and doing research on building climate and flood models. So that's been a little bit on my career. At Moody's, of course, to give you a little bit of a history before I talk about how we build these models. So as you can see here, Moody's has a history of more than 100 years of service across different segments of the industry. Formerly RMS, which was acquired by Moody's about 4 years ago, is one of the companies that pioneered the catastrophe modeling since 1987. It started with earthquake modeling, and they developed one of the first catastrophe models that came out of Stanford University. So we've been in the field for at least 30 years. We're part of the Moody's Insurance Solutions. We have a very big team of more than 300 modeling members, more than 180 PhDs across 20 disciplines. And then we have, of course, models and that cover more than 120 peril regions. So across not only the US, but across different regions around the world. And of course, it started with, and Karen really gave a very nice background on the history of catastrophe models. So again, it started with earthquake, and then after 1992, we expanded to hurricane. And of course, since then, we have been looking at other perils such as flood and wildfire. So as you can see, history plays a very important role here, because really perils that have been in the industry for 40 years or so, of course, we have more advances, we have more data, higher frequency of events as compared to events such as wildfire. 10 years ago, wildfire was perceived as a peril at its infancy from a modeling perspective, given it, the way the industry was reacting to it and so on. So I'll talk a little bit about some of the key drivers that are, I would say, influencing the wildfire risk landscape, and why this is important when it comes to thinking about wildfire modeling and the uncertainty and what would that mean. What we've seen, of course, is a significant escalation in the hazard profile, and Karen really showed some nice examples on some of the losses in the industry and how that has been changing over the last 10 years now. So we examined very closely what are the key drivers that are influencing this change in the hazard profile. Is it a warmer temperature? Are we seeing the wet becoming wetter in certain cases, which means more vegetation, and then the dry becoming drier, extended drought conditions? And how does that impact, for example, the fuel in specific regions? And I'll show some examples on that with what happened in California. And a very important dynamic is also the growth or continuous expansion in wildfire-prone areas, right? So that's another one where we pay very close attention in terms of how is the built environment also evolving. You have also aging infrastructure. I'll show some example, and I think some of the examples that were given were showing, for example, fires attributed to utility companies, right? So this is a very important one, because this is also dynamic. You have aging infrastructure, but at the same time, you have also investment from utility companies, communities, and so on in mitigation. Wildfire is very destructive peril, as you've seen, and this is one of the examples from our reconnaissance team that we sent to LA County, Altadena, and the Palisades area. You can see it's a very destructive peril, which means, of course, reconstruction cost, additional living expenses. How long is the community going to take to recover plays a very important role when it comes to evaluating industry losses. So we take a lot of that information in terms of when we model the risk, and I'll talk a little bit about that as well. Advances in modeling. 7-8 years ago, when we released our version 1.0 of the wildfire model to the market, it was state of the science, but since then we have seen a significant change in landscape data, and we've also seen significant advances in computational power. So when we released our newest model, which I'll talk about, October of 2024, coinciding just a few weeks before the LA fires, we were leveraging the advances in computational power. We doubled our stochastic catalog to create millions of events, which I'll show what that means really and why that is important. We also introduced a lot of mitigation and resilience factors. So user can go in and plug, for example, well, I have a specific property that has been hardened, or there's a specific community today that has been investing in vegetation management, or what we call mechanical thinning in certain cases. So what does that mean, and how is the model going to reflect that? So these are some of the important factors that how these models are essentially evolving as the risk evolves, and also as the advances in modeling are coming more and more in this peril. Now, how do we model wildfire? As you can see, there's really three important elements, right? You have the natural environment, you have the built environment, and then of course you have the human factors, right? Now here, natural environment could be the climatology, it could be local weather, it could be different factors such as the underlying vegetation or fuel. So these are factors that are very important, but of course, it's very important to look at how they interact with the built environment, right? So you could have, of course, a wildfire, but it doesn't mean it's going to trigger like what we just saw with the LA fires, right? So the built environment plays a very, very important role. what's the structure density, what kind of material are being used in that specific community or house. Are we seeing connective fuel? What's the distance to vegetation? What is the type of infrastructure, street width, and so on. And then, of course, there are very important other elements, which is the human element, right? And this is a peril, as you can see, is very complex, because here at this point you're talking about, is the community prepared? What's the source of that ignition? What's the fire suppression and intervention that is happening? So as you can see, that it's a very multifaceted, complex, I would say, peril to model, which means that there needs to be a very important understanding of how to use these models, right? A model is I always, when I teach modeling, I always remind the students that a model is an imperfect representation of a very complex phenomena. So we really need to understand the underlying assumptions. We need to understand how this model was validated. Is it fit for purpose? What is the use case we're trying to achieve, and so on. And so we create not only the models, but we also create very thorough documentation for our users, and documentation on the methodology, documentation on the validation, documentation also on understanding change in results if there's an update to the model version, and so on. So that's a little bit on the overall, I would say, primer and overview of how we sort of, what are the different factors that goes into these models. And now within our Moody's RMS model, of course, this is a high-level overview of the key features of the model, and similarly to what Juliana mentioned and what Karen also mentioned, this is the probabilistic model, right? The reason why we build these probabilistic models, because really each event is unique and different, right? So I give the example of, well, if the LA fires ignitions happened in a different month or under different wind conditions, the outcome would have been different, right? So there's really infinite number of outcomes that could happen, and that's why we run these hundreds of thousands of simulations to create millions of simulated wildfires to understand really where is the area that is at high risk and what is the return period of potential loss, right? The model covers the contiguous US, so we have all states, because as you've seen, I live in the New York, New Jersey area. We had wildfires October and November last year. We had wildfires earlier this year. And wildfire is, of course, a risk that could be anywhere. The only, I would say, key differentiator here is, do we have potential wind conditions and potential structure density conditions that could lead to this urban conflagration or structure-to-structure fire. Smoke fire is a very important one, which smoke modeling is a very important one, which I'll also touch base on. We have, of course, in addition to the probabilistic models, we also have our underwriting data layers, right? So these are users or underwriters that would go and say, well, I don't want to use the model for portfolio management. I want to understand, for example, risk scores. Is there wildfire hazard data, urban conflagration risk, loss cost, and so on. So these are data sets that users can go and they provide a lat long, or they provide some characteristics of the properties that they're interested in, and the model will give them the scores. On the right-hand side is some of the factors that I will touch on at a high level: amber modeling and smoke modeling and urban conflagration. These are really the key elements, because when you think of wildfire, when I look at historically, I would say we have about 70,000 wildfires a year in the United States. But the ones that are creating these big impacts and big losses are very unique. They happen when we have urban conflagration. So I'll talk a little bit about how we model that. Of course, we have what we call a wildfire attribution model. So this builds on a very unique partnership with utility companies to understand, well, if a wildfire is happening or within our stochastic catalog, is that potentially attributed to a utility ignition or something else? Of course, mitigation and community and property mitigation is very important. So I'll show some examples on how we model that. Of course, financial modeling is also another one, and then specialty risk, right? Because when you think about it, right, residential properties are very different from commercial, right? And then you have a different spectrum, which could be, for example, wineries. It could be factories. Those have specific damageability curves that are very different than what you see in residential buildings. Now, when you look at the wildfire model, it's a very similar framework to any other catastrophe model that we have within our modeling suite. So there's 5 components. The first component, which I alluded to, is the stochastic catalog. So here we look at thousands of years of potential wildfire scenarios. And then we have a hazard model. And what that hazard model is going to do, it is going to give us information on the spatial extent and intensity of the heat, embers, and the smoke, which I'll double click on that in the following slide just to show you an example of how complex this is. And then the third aspect is the exposure model. So the exposure modeling means now at this point, the user will go and upload their portfolio. Their portfolio could be a residential line of business, it could be a commercial, it could be a mix of both. And when they upload that information to the model is going to start looking at, okay, where is the location, what are the primary characteristics, what are the secondary characteristics. So there's all that information that goes into this exposure model. And then the fourth component is the vulnerability, right? Because as you've seen in these recent events, you could have 2 adjacent properties, one of them fully destroyed, the property next to it potentially not even impacted or having some smoke impacts or minor damage. So there's a lot of variability in terms of how a given structure is going to respond to embers, or it's going to respond to the fire, flame, and so on. And the final component of that modeling framework here is the financial model, right? At this point now, the model is going to take into consideration the policy terms and conditions, and so on, to quantify the losses. As Juliana mentioned, it could be an average annual loss, it could be an exceedance probability curve. So this will inform really companies on a view of risk in that specific area. As you can see, there's 5 different components, but it gets even, I would say, more complex, because if you look at the hazard only, you can see here that the hazard only has 7 subcomponents, if you will, right? As you can see here as an example, we take into consideration the surface fuel, the canopy fuel, and then of course this is highly variable in space, and also could vary, I would say, with time, right? Because today, if you look at an area that is potentially that has specific vegetation, in a year or so, if you have drought conditions, that vegetation could be conducive or could be conducive to wildfires, right? And then you have the climate conditions, right? Because here, what is the current climate? How do we condition these models? How do we trend them to make sure that they start with an initial condition that is reflective of the climate we're living in today? One thing to add here is we also have a future climate.
Headphones and all sorts of things.
So we have a future climate projection model as well. And then what this model does, it looks not only into what is the current state of the climate, it looks into, for example, 2030 or 2040, and how could the climate potentially change and reflect how the losses could also evolve into the future. So this is another one that we also do a lot of research to understand. Simulated ignitions is a big one, as you can see here, because really you could have all the conditions available, but if you don't have the ignition, then of course you won't have that wildfire. Here, about 84% of the ignitions that we see historically are human-induced ignitions. I'll show you an example on that in the following slide. And then, of course, after that, you have the fire spread component. So now at this point, you have the ignition, you have the fuel, you have the climate conditions, and then the model is going to simulate the spread of that fire for every given footprint of these millions I was talking about. And then eventually, the 5th component is the ember. Embers, of course, as some of you know, or most of you know, could fly up to 2 or 3 miles. It's quite unbelievable when you look at it. We do a lot of research with the Insurance Institute for Business and Home Safety to understand embers intensity, how they fly, where they accumulate, what's the impact of wind speed and wind conditions and directions. That plays a very big role. And the big one, of course, is the urban conflagration, which I'll talk about, because this is now at this point, the embers start to accumulate in a town or in a specific area and triggers what we call that structure-to-structure fire. And the question here is, how bad is it going to be? What are the number of structures that will be destroyed? And then the last one is the smoke spread model. This is one which is also very important, because when we go and visit these areas after they get impacted by wildfires, we see a lot of losses from smoke, right? Because you know, some of the scenes we've seen is you see carpet outside, furniture outside, and there's a lot of claims that are generated from smoke. Now, to give you an example here in the next maybe few minutes, this is one where you can see we're looking at historical ignition data. As you can see, ignitions are happening everywhere in the US. And here, this is a really good database that is coming from the Fire Program Analysis Occurrence Database. You can see it's attributing the ignition to, is it lightning, is it equipment, right? And then you have, of course, is it power line? So this is something we look at to make sure that we have a good understanding of the sources of ignitions, and they also they're being used also to inform how we perturb the model and so on. Then once the ignition happens, you can see here, this is a fire spread model. It's going to go and look into the vegetation. It's going to look into the underlying condition, and it's going to see, okay, where is that fire going to spread, right? So a lot of information here, right? It could be influenced by fire suppressions. So there's that human element that also goes into this model based on underlying assumptions. And then, of course, after that, we look into the ember intensity. And here's an example from one of the urban conflagrations. As you can see, what the model produces here is these darker pixels are representative of what we call these ember footprints or urban conflagration. And it could be highly variable. In this case, we're showing one example, but you can see within the footprint, it could be significantly higher if certain wind conditions existed and so on. And this is the example I'm showing you here comes from Coffee Park and with the Tubbs fire. Another one is smoke modeling. Here is an example of a model smoke footprint. So we use an emission and transport model, and we use that. Users can switch it on and off to allow them to understand what's the contribution of smoke. And I think this is just referring to the comment I made earlier, because these are some of the scenes we saw when we went to the LA fire area. And you can see here a lot of this property specifically was not impacted, but you can see all the furniture is outside, and you know, these claims could be tens of thousands of dollars. So this is an important one from I would say from a modeling perspective. The model also looks into all these, I would say, specific factors, right? Which is what is the street width? Are embers potentially accumulating in these specific roof characteristics and so on? So this is one thing that we work very closely with the Insurance Institute for Business and Home Safety to understand. And this is an example of some of the experiments. I was there a few months ago, and here you can see that this is a wind tunnel. They generate wind, and they have two adjacent properties. I took these pictures, and then they look into, okay, where are the embers going to accumulate? Well, and also what is the distance between these two structures, and what would that mean, and so on. So all that goes into the modeling. So it's not only the reconnaissance, it's not only the modeling, it's a lot of the validation and the experimental that we learn. And we also have, of course, as you can see here in the damage model, all this information. So users can go and let's say, oh, I know more information about fuel type. I can go and overwrite that in the model. I know information about distance to vegetation that is very recent from recent surveys. I can go and input that into the model and read on the model. I have some information about, for example, roof characteristics, fire suppression. You can plug that into the model. And sometimes we see users, even if they don't have all the high resolution information, they go and use the default underlying assumptions, and they essentially go and do some sensitivity analysis to understand the sensitivity of the model to some of these parameters. So a lot of, I would say, partnership with major organizations that allows us to do all this research, allows us to build these models. We work very closely with the US Forest Service, CAL FIRE. Our clients share with us a lot of information in terms of exposure, claims, and so on. And we learn, so we're constantly learning, I would say, from this unique partnership. I thought maybe just to wrap it up with one example of what we saw from the LA fires, and the next, maybe I have 1 more minute left or so. Just to sort of recap why this modeling complexity is very important. If I look at what happened with LA fires, as you can see here, which is quite interesting, prior to the wildfire events that happened in Los Angeles in January, we had very wet conditions. We had, of course, April of 2023, we had, through April of 2023, we had atmospheric rivers that brought significant rainfall amounts. And then we had Tropical Storm Hillary. So all that rainfall, which is above average conditions, created much larger vegetation. And then we had one of the driest, I would say, 9 months on record in that area. So which means that, of course, moisture gets depleted, and then that vegetation becomes conducive to wildfires. So that's a very important element as of why we look into the antecedent conditions and so on. And then, of course, we had the Santa Ana winds, right? So it's really a combination of factors, unfortunately, that led to this tragic outcome. And that's why we create all these permutations of different conditions to understand. And now from the lens of the model, given we had just released the model, the first thing I did was I wanted to validate, and I think it goes back to one of the questions we had, is how does the model perform in areas where you have not had historical fires before, right? And as you can see here, these are 5 of the stochastic catalogs from our model. The blue polyline is the fire, I would say, limit. And as you can see, the model is showing us different scenarios. I would look at the 4th one on the upper panel. Here you can see these darker pixels are the urban conflagration or the properties that got destroyed, where the model is showing that very clearly. And then the model is also showing that could have been a larger event if wind conditions would have potentially stayed for another 6 or 12 hours, or suppression conditions. Similarly, I would say with the Pacific Palisades, fires could have also been worse. But you can see the model is reflecting basically the risk, right? So this is really how these models are allowing us to better understand the risk in areas where potentially we have not seen big fires before. And what we did eventually is, of course, we created these footprints that validated the model. So we looked into the damaged, destroyed structures, and we validated with these darker pixels that are from our model showing the full destruction. So this is a way of how we look into modeling, how we validate these models. And again, I think it's one of the speakers made a good point. It's really the paradox of modeling, right? You model, you build a model, you create all that granularity, but then also you have more events, which are quite unfortunate for communities and the industry, but the data that we collect from that help enhance these models and also help validate these models. So I hope that was helpful. I'll leave you with the last slide, which is these models are not only about informing insurance, reinsurance. These models are allowing communities to understand and enhance resilience. They're allowing us to bridge the gap in certain cases with the insurance affordability, identifying emerging risk, raising awareness, educating communities on the role of mitigation. So it's not really about insurance and reinsurance. They have a much broader use case. And with that, I really appreciate everyone's time and attention. Thank you very much.
Thank you very much. I'm going to invite Brian to present, and then we'll come back if there's any comments or questions on your presentation. So, Brian, over to you.
Okay, thank you very much. Okay, can you all see my screen?
Looks good. Yes, thank you.
Excellent. All right. So thank you very much. And special thanks to David Fort and the Washington OIC for the invitation. So my name is Brian Rehor. I'm the Director of Regulatory Affairs for Zesty AI. And we are a San Francisco-based property risk analytics company. And we're probably best well known for our Z-Fire product. So Z-Fire is our wildfire risk model that I'll be talking to you about today. It's served the property industry, the property insurance industry for about the past 5 years. We're used by many of the leading property insurers across the United States. And what differentiates us from some of the other speakers that you've heard today is we're focused specifically on risk models, so the segmentation aspect of modeling. So we're not focused on simulating large-scale events. We're not looking at probable maximum loss. We're looking at property-specific insights that can be used to determine what's going to happen in the next 1 to 5 years. So we have a very short-term time horizon that we're looking at, but for that reason, we're used very widely by property insurers to rate and underwrite property insurance with fully transparent risk scores. So I'll talk a bit today about what we define as transparency and how we have pioneered more transparent risk models for the industry. But because we have these very, very granular and very, very useful insights, there is an emergent use case for government entities to identify and mitigate some of these high-risk areas in their states with these property level insights. So we're going to talk a little bit about what that use case looks like and what that could also look like for Washington specifically. So overall, accurate risk models, as you've heard from the other speakers today, are incredibly important for a well-functioning insurance industry that serves everybody, even those people living in high-risk areas. And we believe zFire can also be used to give those insights to make our communities safer and to make our communities more resilient. So before we go on, just a bit about who we are. So like I mentioned, we are a property and climate risk analytics platform. And what we do is we derive billions of property level data points, many of these from unstructured data sources such as aerial imagery. So if you think about what drives property specific wildfire risk, we hear a lot about defensible space. There is no one good measure of the defensible space that's on a property. It just simply doesn't exist. So that's why we created the technology using satellite and aerial imagery to be able to extract that from properties. So extracting defensible space, extracting insights about the roof and the material, and also lots of other information about the property and the environment that it's constructed in, such as the climate. We're able to then take all these insights and cross them using machine learning techniques. So that's a branch of artificial intelligence. And through this modeling technique, we're able to then develop risk models that have pinpoint property level accuracy. And zFire is just one example of the many solutions that we offer. Then insurers can then take our models, which is essentially a score, and use that to make more informed, better decisions. And overall, that better information is what helps them, write with confidence in a state, understand what kind of risks they're taking on their books, and be able to price those risks appropriately. So that's what we do. And it's no surprise that wildfire losses have grown over the past decade. It is cyclical, but overall, over the past decade, 35% annual growth rate in the total industry wildfire claims in the United States. And certainly California is a recent reminder of this. And as some of these major events occur, this does create a change in some of the strategies that we see from insurers. So insurers start to become a little bit more conservative. They want to see what they can do to be able to prevent these shock losses from occurring in their books. So this is another recent reminder of what is an increasing trend over the long term. So why did we create zFire in the first place? Historically, it's been because broad brush wildfire models have identified vast portions of the United States that are high risk. Washington is certainly no exception to this. And insurers using traditional models have kind of relied on some of these broad brush models to take blanket rate increases, to do vast non-renewals, in the case of California and many other markets, withdraw from the market completely. So this is just one example of what a wildfire risk map looked like in the area of the Tubbs fire in 2017. So here are some of the properties that were destroyed as a result of this. You can see many of them are within what that model defined as being high risk. But you can see that there are many homes that fell outside of that designated zone. So you have two issues here. You have a model that was missing many of the homes that were actually at risk, and at the same time labeling entire areas as being broad brush, high wildfire risk, which can lead to blanket rate increases and non-renewal. So this is something that Zesty AI set out to change. So we created the world's largest wildfire database. What we did is we analyzed the footprint of over 1,500 wildfire events across North America, including those that occurred in Washington. We also analyzed each and every property that was located within the footprint of these homes. And what we noticed is that while some homes in these footprints survived the wildfires, others did not. And we wanted to find out why. So what we did is we obtained aerial imagery of each and every structure before and after the wildfire events. And we pulled other data points such as the climate and the geography of the area. And then we used those machine learning techniques that I alluded to before to understand the complex relationships between the property and the community level attributes. And the result of that is our Z-Fire model. So you can see in the image on the right, this is a good representation of the property level pinpoint accuracy that you get at a neighborhood level. A traditional wildfire model might label this entire area as high risk, but you can see that our model identifies some structures as high risk and some as low risk. So what that means is an insurer using our insights, they might be more open to writing properties in this area rather than saying, the entire area is out of our risk appetite. They'll also be able to price each home according to its risk level. So a very well mitigated home would actually get a lower rate than they would have otherwise if the insurer viewed this entire area as having a uniform risk level. So that's in essence what Z-Fire does and why we created it. So I'm going to get a bit more into the mechanics of how it works and some of the insights that we can glean from Z-Fire. And then we'll also look at what that means if we took this outside of the insurance use case and applied it to the government and policy use case. So what does Z-Fire get you? So I talk about Z-Fire as a model. It's actually two distinct models. There is a neighborhood-specific score as well as a property-specific score, because we all know it's not just about the location that the home is located in. It's also about what makes the home unique and how well mitigated is it against a wildfire. So that's why we have two different risk scores. All we require is a property address. And in just a couple of seconds, we're able to gather these dozens of data points, including the data points that come from aerial imagery, such as the climate of the region, the amount of vegetation within 3 distinct zones, the material of the roof, etc. And we're able to then determine the neighborhood score, which is an annual probability that that home will be involved in a future wildfire footprint. Not saying anything about whether or not it will survive, but simply will it be included? And then the property level score, also a score of 1 through 10. Now, this is where we get into the survivability aspect. So how well mitigated is this property should a wildfire occur? So we assign that a score of 1 through 10. And many of these are going to be those property-specific features, such as the vegetation, proximity to other structures, the material of the roof. So not only does an insurer get the property and the neighborhood level score, but they're also going to receive from us the top risk modifiers that are driving that score to be high or to be low. Now, this is extremely important, especially when you look at the property level score, because we all know there are many things a homeowner can do to be able to reduce their risk. So historically, if you got a high property level score, homeowner wasn't able to first of all understand why they're receiving such a high score. And they don't know if there's anything in their power to be able to bring that score down. So now with our top 3 risk modifiers that we deliver directly to the insurance carrier, a policyholder is able to take those insights and determine, is there anything that I can do to lower my score? So is there any potentially overhanging tree limbs that's driving my score to be high? Is it my 0 to 30 amount of vegetation, 0 to 30 feet vegetation that can be thinned out and potentially lower the score? So we give those insights directly to insurance carriers, and we also give them a way to embed that information in policy forms. This is what we created to comply with California law, and it's something that we can do in Washington as well. So that insight on what can be done to lower my score is very important. We also provide what's called the appeals process. So that means if a customer disagrees with their risk score, or maybe in a rare occurrence there is something inaccurate about their risk score, they actually have the ability to go to their insurance carrier, and their insurance carrier can then take a look at what are all the inputs into our model. Are any of them potentially incorrect? Did the customer update anything? Did they clear some vegetation? and they can remodel the score assuming different scenarios. So they can say, all right, well, if we clear your overhanging tree limbs and then we trim your surrounding vegetation, so it's just maybe 10% instead of 40%, what would that do to your risk score, and what would that do to your insurance premium? And in some cases, could this previously ineligible risk be a risk that we'd be willing to accept? So there is a pricing aspect as well as an eligibility aspect that can be done with this. So a lot of transparency that goes into the scores. One other point I'd like to make is we use aerial imagery that's recent, up to 4 times per year per property, generally between 2 and 3 times per year per property. So we source the latest image that's possible. Generally, that's going to be within the past few months. So that means we're automatically capturing any mitigation that might be occurring. We're capturing new vegetation growth, and insurers are able to access these insights every time the policy renews in the next year to make sure they're always rating the property according to its current level of risk, not from a static database that was updated 2 years ago. So that's a bit about our Z-Fire score. You have a neighborhood score, which is also known as a level 1 score, and a property score, which is known as a level 2 score. So let's look at what Washington looks like, and we mapped what every home and their level 1 score is in the state of Washington. So we don't use the map. This is just for visualization purposes, but we took a recent snapshot of the state for both level 1 and level 2. And this is, the map that you see is what the risk level looks like. So it looks very daunting, but if you look at the distribution of properties across the state, the good news is 86% of Washington homes are considered very low or low annual risk of wildfires. That's what we call a score 1 or a score 2 on the level 1 score. This is very close to 0% probability of being involved in a future wildfire. So that's the good news, because you can see on the right-hand side, as you step up on your level 1 score, you step up in the probability. Or a score of 10 represents over a 1% annual chance of being involved in a wildfire. So very, very high amount of risk. But as you all know, it's not just about the probability of wildfire, it's also the survivability aspect. So we did the same exercise. We mapped every residential property in Washington according to its level 2 score, and we looked at the distribution. So this is where you see a bit more of a skew to the right, the higher scores. Only 15% of Washington properties are at a very low or low annual risk of being damaged. So this is where we get a little bit more concerned, especially when you have the combination of a high level 1 score combined with a high level 2 score. And you can see that like level 1, the level 2 probabilities increase very drastically. So a level 2 score of 10 out of 10, that's an 84% chance that your home will be destroyed in a wildfire, versus a level 2 score of 1 is almost 0. So it is possible for a home to be in a high wildfire prone area and have a level 2 score of 1 or 2 or 3 and have a very high percentage or probability of surviving that wildfire. So when you look at the 2 scores together, you can see that your understanding of risk goes from just 1-dimensional to 2-dimensional. So if you looked at all of the homes in Washington by their level 1 score and their level 2 score, now we're most concerned where there is a moderate to high level 1 score combined with a moderate to high level 2 score. That's both high probability of an event happening as well as a high probability that that home is not going to survive the fire. So when you look at that, there's about 10% of homes in Washington that we consider to be moderate risk, and about 1% of homes that are extremely high risk. So what this means is this is a very targeted insight, and we can look specifically at which homes are driving this, and a lot of these are going to be clustered together. So what that means is it's possible to build a very targeted mitigation plan and build policies that are focused on the areas that need them most. So that's what I'm going to talk about in kind of the second half of this presentation is we can give these insights to insurers. They can use these to make rating and underwriting decisions. But where we can also see the impact and where we're working with another state currently in the West is using these insights to make better policy decisions and potentially impact people in the next wildfire season. So there are really 3 steps today that I want to review. And since we have this pinpoint property level view of risk, we can use geospatial analysis and try to look for clusters or pockets of high risk properties. So these would be properties within a high risk area that also are not very well mitigated. We know from our models that if a wildfire were to occur, they'd have an almost 100% chance of not surviving that wildfire. So we have the insight to be able to identify which properties those are. And then we can also overlay, some of these insights with legislative districts. So we can begin making policy decisions and view on kind of a legislative district scale what the risk level looks like. So the mapping techniques I'll share in just a minute. Another very interesting use case, and one that we've actually partnered with a nonprofit on, and I'll share the results of that, is remodeling scores to reflect and simulate different mitigation activities. So because we're able to do this remodeling, we're able to look at homes that might be in a high wildfire area that are not well mitigated and simulate different mitigation activities. We can do this at scale and then understand what is the balance of risk and reward. Are there specific areas where a small amount of investment, maybe that's in the form of grants or some sort of funding, can be deployed and then lower the risk level in a very meaningful, measurable way? So this is something that we can also do, is that remodeling. And the third one is, because we are in insurance, the insurance use case was our very first use case. We want to support this transparent risk-based pricing. So right now there is no good model review process in place in Washington. Other states such as California have come up with a good foundation that I believe Washington can look to as an example of how to review these risk models so that insurers can use them in their products and be able to get them deployed efficiently. So let's look very quickly at level 1. So we can use a geospatial analysis and looking at the level 1 and level 2 scores, find out where are there clusters of high risk properties. So we're able to look at really whatever granularity we need to. This example looks at 5 square kilometer hexagons where wildfire risk might be concentrated. So by doing this analysis, we're able to identify very quickly what are the areas that need the most help, what are the areas we need to be focusing on. And because it's just maybe 11% of properties in Washington, this allows us to immediately have much more focus. And like I mentioned, you can aggregate this however you want. So in this example, we can aggregate it by Senate district. And once we kind of understand this, we can go down to the property level and figure out, all right, which types of mitigation activities would have the biggest benefit on the property level. So step number 2, this is where we can really make a very large and meaningful and immediate difference, because we understand the probabilities of destruction and how those decrease with different mitigation. So this is one example where a property scoring a level 2 of 8 was able to reduce their score to a property level score of 5 by clearing vegetation around their property. So this is something that we can simulate on a single property. It's something we can simulate on an entire portfolio. And that immediately identifies what is the biggest bang for your buck, so to say, if you were to deploy some kind of funding or grant money to be able to perform mitigation on the property level. So this is something that we undertook with a nonprofit called SBP. SBP is focused on rebuilding after disasters. They're also trying to get more into resiliency and mitigation. So SBP partnered with Zesty AI to look at many vulnerable communities across the Western U.S. And attempt to figure out which communities are in the most need of mitigation, and then what are the specific activities that need to be done. So we partnered with them, and this was an idea that was submitted into IDEO's Climate Resiliency Challenge back in 2023. There were 300 applicants, I think over 300 applicants, and SBP actually won first prize and was able to get actual grant money and deploy it for mitigation. A lot of it has to do with vegetation removal, tree removal in 3 vulnerable communities in California and Arizona. So through this analysis, they were actually able to determine that within these 3 communities, by following the techniques recommended by ZestiAI, they could reduce the destruction risk in the event of a wildfire by 43%. So cutting it almost in half just by performing targeted mitigation and properties that would benefit from that mitigation the most. Over time, they forecasted that if insurers are using the Z-Fire score, 8.5% reduction in homeowners' premiums could be expected because of that lower risk level. And
Brian,
also 160, yes.
I'm sorry for interrupting you. I just would ask if you could finish up in the next minute or two, so we have a few minutes for questions.
Absolutely. Yeah, we're almost finished here. So let me. I think we get the point here. A very large amount of benefit from this partnership. This is something that could be deployed in Washington as well. And then we'll definitely continue to advocate for risk-based pricing, because this is extremely important for a healthy insurance market. We are engaged right now with OIC on carving out a process, and we believe that the process in California serves as a good example of how you can have a transparent model review with public participation, but also protect intellectual property and avoid replication. So just once again, these are our 3 recommendations on how Washington could utilize ZestiAI insights to be able to create a safer and more resilient Washington. So that is the conclusion. I welcome any questions, and if you'd like to reach out to us directly, you can reach out to us at regulatory@zestiai.ai. Thank you very much.
Thank you so much, Brian. Sorry for cutting you off there. I know we have a whole bunch of questions in the chat. So I think I want to, Tony Craven, let's come back to you if you still have a question. And everyone is welcome to raise hands. We also, if we don't get to everything that's in the chat, we'll make sure to capture those and invite the presenters to answer them in writing afterwards. So Tony, do you still have a question?
I have lots of questions, but let everybody else go.
You have one question for us?
Nah, let everybody else go.
Okay. All right. Thanks, Tony. Who else has a question they want to ask? Yeah, David, please.
Great. Thank you, Kelly. And I just want the work group to understand that the folks that we heard from today are the top 3 modelers used by insurance companies in Washington State, and we're very thankful that they spent some time with us. And if I could just get a quick response from all 3, and to clarify, your modeling assesses the likelihood of a wildfire being present at a location, or is it reflecting the specific structure at the location igniting if a wildfire is present, or does it do both?
It does both from the modeling of the Moody's RMS. So, yeah.
Thank you.
Yep.
Juliana?
I'm sorry. So our tools, Fireline has sort of a built-in assumption that the fire will have reached the property, but it also wouldn't have reached it if the fuels weren't conducive to that. The CAT model is like what Faraz said. Our catastrophe model looks at both. So we have both tools available to carriers.
Thank you. Brian?
Yes, and David, just confirming our model does do both.
Thank you. Do you have another question, David?
I do. Thanks.
Perfect.
Like Tony, lots of questions.
So many questions.
I want to re-raise a question that was asked to Karen. How is local fire department capabilities reflected in the models? How are you capturing that type of data?
So I'll start because the company she was referring to was Verisk and ISO. We do have the public protection classification, and Karen was spot on that is intended to assess fire department's capabilities for responding to a single structure fire, or maybe a couple of involved structures. And the research that's being done on understanding the suppression capabilities for these urban conflagrations is ongoing. That said, we do have a suppression algorithm in our catastrophe model that does demonstrate differences depending on certain conditions. I'm not going to get too into that, but that is accounted for in our catastrophe model, and it is. I mentioned the road access piece in current fire line that is a proxy for suppression. It does analyze that. And one of the things that I think is really important. There's an interest in seeing really detailed granularity on those sorts of efforts, and the research is ongoing. So I want to say that clearly. But what's really important to insurers is the predictive value of those features and those factors. And so we have tested over and over again that road access is a predictive feature. And so it does provide predictive analytics for the carriers to assess that piece of it.
Thank you.
And maybe
Tony.
Add
I'm sorry.
No, I was going to say maybe to add, right, like within our models, for example, we also include the suppression options, right? So this is one of the secondary modifiers where the user can go and say, well, do sensitivity analysis or compare active versus passive suppression. But I think it's also important to acknowledge, if you're looking at an event like what happened with the LA fires, you're talking about winds exceeding 80 miles per hour. So the minute you have that urban conflagration, there's really limited, I would say, suppression that could happen at that point, right? So that's another important factor that we look into historical data, historical events to correlate and make some assumptions on the suppression.
Thank you. Brian, do you have something to add on this one?
Yeah, and for Zesty AI, we do have one model input that reflects the distance to the closest fire station. So we're also looking at additional features for our next iteration of the model. So this would be something that would be in development. I also want to point out, so Karen Collins pointed out the use of property protection class. So you have to keep in mind that when an insurance carrier uses our model, it's not the end-all be-all determination of wildfire risk. There might be other components of their rating plan that are used in conjunction. So protection class would get at kind of the staffing capabilities and volunteer versus paid firefighters, and this would be another rating factor that's overlaid on top of the Z-Fire rating factor. So it's a little bit of both, but we're continuing to see if there's additional data points that can enhance the model performance in future versions of it.
Thank you. Tony, do you have a question?
Oh, mine wasn't so much a question, but being a person who's had access to lots of fires or firefighters in a given moment, the fire district suppression ability is really not going to factor in except on the 95% of fires that we already catch. And generally the insurance carriers are looking at the upper 5% or even just 98%. And in those cases, you could have 300 firefighters sitting around, 2 air tankers, 5 helicopters, and we still lost part of Wenatchee. So I'm just throwing that out there.
Thank you. Okay. David, tell me, you wanted us to go to a question in the chat. I'm not reading fast enough.
Oh, sure. I can ask it. There was a couple questions relating to satellite or overhead imagery and the accuracy of being able to tell Class A, Class B roofs, roofing material, and also vegetation and vegetation types. Do you have any comments on the accuracy of your imagery that you use?
You're asking all three of the presenters? Yeah.
Yeah, I'll go ahead and jump in on that too. Our aerial imagery is very precise and accurate and detailed, and it does an excellent job of classifying the roof type and the roof condition. We actually have a separate product that's a roof type and condition product, but we use the similar or same imagery for that. But there's also always the ability for a consumer, if they believe it's wrong, to go through their carrier and correct that information, and it can be changed if it's wrong. So that's also really important. That also goes to kind of what Brian was saying about the transparency piece of it.
Yeah, I think Giuliani make a good point, right? So within the models, right, you have within our model, you have the option of just saying it's an unknown, a roof type, for example, or primary characteristics. The model will infer that information from the underlying inventory. Now, if you have access to, let's say, more accurate or recent information, you can go and plug that as the primary characteristics of the exposure, and then you can rerun the model. We just acquired actually a company called Cape Analytics. This is a property level risk intelligence company, and they do satellite imagery. They do airborne and high resolution imagery on roof. They could even identify clutters, trampolines, all that information, distance to vegetation. So this is information, let's say, that comes at higher frequency as compared to how often these models are updated. So the user can go leverage that information, plug it in the model, and understand the differences and the relativities compared to the baseline.
I can just add a few points from the perspectives SCAI. So we use multiple imagery providers. So that means we're always getting the most recent, highest resolution image that we can to make a determination. And then when it comes to determining the roof material, we have statistical methods to test, what is the precision and recall. So really just the overall, accuracy of determining a roof material. This is one a model that is extremely high accuracy, and it's not very difficult to determine based on the cosmetic or the appearance of the roof. And we use basically a labeling technique that looks at thousands and thousands of examples, and the computer is able to learn exactly how to tell a tile roof from a shingle roof from a wood roof.
Thank you. Commissioner Kuderer, you had a few questions in the chat. Is there one you would like us to wrap up with?
Sure. How about, how do consumer mitigation efforts reflect in the score?
To all three panelists.
Yes.
Yes,
and
presenters.
And I'm also going to ask them to add, how often is it updated?
Okay.
I think it's helpful. Thanks.
Brian, do you want to start for us?
Absolutely. So there's a couple different ways that mitigation would be reflected. So first, automatically, because we're using imagery that's refreshed up to 4 times per year. So if a customer purchases an insurance policy and then they decide to perform some mitigation, clear some brush, clear some overhanging tree limbs, by the time that policy renews, we will have obtained a fresh aerial image, and that would automatically be reflected by the carrier in their insurance rates. So that's the first way. The second way, if a customer performs mitigation and they contact their insurance company and they say, hey, I want to know why my score is so high, then the carrier could tell them why it's high and then simulate what mitigation could do. And then the insurer could verify that they, in fact, completed that mitigation. The customer can send pictures, and then the insurer can override that input, and they would get the benefit immediately. So those are the 2 different ways that mitigation would be reflected in the scores.
Thank you. Juliana?
Yeah, I just wanted to address actually, I think, a really important question that's in the chat about whether or not there's been comparisons of the modeling and whether there's been any discussion about a single standard for scoring. And we have tremendous respect for all of our fellow modelers and all the great work that they do. What we see is that the open market, the market forces actually do this for us. The carriers, they do their testing on their own books of business. They end up expressing preferences for one or the other, or often multiple models. We see that happening a lot, where they're using more than one model in order to see how it works on their book of business, and then they end up coming up with their own analysis that is where they find their comfort level. And it may be different from one carrier to the next. And so while, California, for example, has just created a working group where they're going to work on creating their own public model, we have no opposition to that. We think that the more models, the merrier. The more opportunities there are for carriers to really assess the risk and their risk appetites, the better. And so going down to just one actually would be, I think, also from my perspective, of the insurance industry perspective, really problematic. It would actually be a detriment to the availability and affordability of insurance in the long run.
Jim, definitely agreed with that input. And I think, models have different underlying assumptions, different data sets, different use cases. That really can't have one model. We have clients, as Juliana mentioned, that use a blended or a different view of risk. Maybe maybe we're out of time, but I wanted to add on the mitigation within our models. We look into community level mitigation and also property level mitigation. So there are these levers where the user can go and say, okay, I know this community had invested in mechanical thinning, for example. So they can go and enter that information in addition with whatever data that we already have from public information and so on.
Thank you all so much. Thank you, Karen, Ferris, Juliana, and Brian for presenting and sharing today. Survey 4 is coming to you via email in a few moments. We appreciate your comments and your questions. Next meeting is next week, the 22nd. You may have seen on the website that we had listed Steve Brooks for today. He is going to connect and speak next week. Also, as we mentioned, we added August 5th as another meeting. You probably have already gotten that invitation, but that's also being added to the website as well. And if we did not get to your question that you thoughtfully put into the chat, thank you. We are going to share those with the presenters and invite them to share more input. I think that is everything. My apologies for keeping you 2 minutes over. Appreciate you, and talk to you next week. Thank you, presenters.
Thank you, everyone.
Thank you very much.
Thank you.